Bismillahirrahmanirrahim. Akaf Saeed Saab, Chairman, SECP. Muhammad Asim Saab, President, CFA Society, Pakistan. Presidents and CEOs of banks and other financial institutions, corporate executives, distinguished guests, ladies and gentlemen. Assalamu alaikum and a very good evening. I am delighted to attend today the 22nd Annual Award Ceremony organized by the CFA Society, Pakistan. I am encouraged to note that we are recognizing financial institutions not just on the basis of their size and profitability, but also for their contributions towards important socio-economic objectives, including gender diversity, quality of research, and efforts to attract investment into our country. I am grateful for the opportunity to be part of this ceremony today and to share my views on the important role that this platform can play in further deepening and development of the financial system of Pakistan. But before I share my views on this topic, let us briefly recall the difficult economic situation we had been when the last time I was here in late 2022 at the CFA Society's 19th Annual Awards. We were going through extremely challenging circumstances at that time, with rising inflation, widening twin deficits, and depleting FX reserves. Many analysts were at that time predicting a sovereign default within a few weeks. However, the government and the State Bank of Pakistan remained steadfast and adopted a series of unpopular yet necessary policy and regulatory measures. As a result, we have moved past that difficult period, and today our economy is in a significantly better position. Inflation is down and is projected to stay within the target range of 5 to 7%. Our FX reserves are now almost 5 times of their low levels in early 2023. We are targeting to increase them further to achieve at least 3 months of import coverage. From the government side, the fiscal consolidation is continuing as reflected in the consecutive primary balance surpluses over the last 2 years. Consequently, our debt dynamics have also improved considerably. Our total public debt to GDP peaked in 2023 and is down by 5% past and earlier phases of our business cycles. In my view, enhancing productivity, boosting exports, and attracting investments in the new and emerging sectors of the global economy. Emerging economies to achieve sustainable and inclusive economic growth, one of the key ingredients is deep and well-functioning financial ecosystem, one that can cater to the financing needs of wide range of public and private stakeholders. In Pakistan's case, the financial system is dominated by commercial banks, which have primarily not in meeting the government's budgetary requirements. This leaves a large gap in meeting credit and investment needs of the private sector. In many emerging economies, this demand for funds is also met by capital markets, which serve as the major platform for financial intermediation. In this regard, Pakistan has lagged behind many other emerging economies in developing deep and liquid capital markets capable of meeting the credit and investment needs of the broader range of businesses and customers. Let me briefly discuss 3 key indicators to illustrate this point. First, the size of our domestic equity market. The size of our domestic equity market, as measured by market capitalization of listed firms as percentage of GDP, is at around 13% as of end fiscal year 2025. According to the World Bank data, till 2024, this is quite low as compared to other major emerging economies, such as India at 131%, Malaysia at 107%, Thailand 99%, and Brazil at 30%. This suggests that despite the recent improvements, Pakistan's equity market remains relatively shallow compared to peers, indicating limited reliance on capital markets for corporate financing. Second, the size of Pakistan's corporate debt market is almost negligible relative to GDP. While Asian economies generally have smaller corporate debt markets relative to Western economies, our market is even smaller than the regional average of 2.8% of GDP. Third, our equity market is also less liquid than those of our peer economies. At 5% of GDP, the traded value of stocks in Pakistan is quite low as compared to India at 86%, Thailand at 57%, Brazil at 42%, and Malaysia at 39%. Liquidity in Pakistan's equity market also tends to be concentrated among a few sectors and stocks, reflecting limited breadth of market participation. Evidence from different studies suggests that liquid markets attract more investments from institutional investors. Closely linked to my previous point is the size of assets under management of investment funds in Pakistan, which remains below 5% of GDP, according to a recent OECD's report. This is significantly lower than more developed markets in the region, such as Korea at 67%, Malaysia at around 55%, and Thailand at 38%. This limited scale of the investment funds industry highlights some underlying structural constraints in our capital markets. This includes a narrow investment base, limited product diversity, and relatively low household participation in formal investment channels. Ladies and gentlemen, addressing these shortcomings is our collective responsibility. Expanding the domestic retail investor base and providing a facilitative regulatory environment are already key priorities that the SBP, in collaboration with other regulators, is working on. Ultimately, it all comes down to financial inclusion. A financially literate population has widespread implications for the broader macroeconomy and investment landscape. This is where financial literacy plays a pivotal role. With a better understanding of how to budget, save, and invest, and navigate the financial system, citizens can increase their opportunities for socio-economic advancement. I am pleased to share that SBP has long been at the forefront of promoting literacy in the country. In collaboration with the financial services industry and academia, increasing financial literacy also remains one of the high-level strategic goals under SBP's Vision 2028, alongside building an innovative and inclusive digital financial services ecosystem. I would also like to take this opportunity to acknowledge the important financial literacy initiatives undertaken by our fellow regulators, especially as CCP, as well as our private sector stakeholders, including CFA Society Pakistan and our brokerage and investment houses. Conducting awareness sessions, mock investment competitions, and award ceremonies like today's event are all commendable efforts by the financial services industry to advance our collective goal of building a prosperous and financially empowered country. That said, as we look ahead, there is a need to broaden our investor base and deepen our markets. Expanding digital access and simplifying onboarding through measures like simpler and streamlined eKYC and small ticket investment options can help bring more individuals into the fold, which can help gradually increase turnover and improve market depth over time. Similarly, we need to expand our efforts through investor education programs to reach more people in rural and underserved areas to integrate them into the formal financial services industry. These efforts align closely with SBP's broader agenda of promoting financial inclusion, which can also help diversify investor base and mobilize more household savings into productive investment channels. At the same time, developing alternative investment products such as exchange-traded funds and Sharia-compliant instruments, along with greater transparency of market data, can help cater to diverse investor preferences and provide broader avenues for participation. On the institutional side, there is a need to improve market infrastructure and governance. Similarly, building corporate governance and disclosure standards to improve transparency and building public trust and confidence are also vital. Last but not the least, upholding public trust to investment avenues is also critical. This is important, especially in times like these, when illicit operators exploit the lack of financial literacy to wipe away people's lifetime savings in a matter of minutes. Ladies and gentlemen, while concluding, I must reiterate that this is the time for us to come and work together to put our economy on a sustainable and inclusive growth trajectory. We also need to make sure that we do not shy away from taking tough policy and business decisions in order to avoid a repeat of the boom-bust growth cycles and long-term economic stagnation. With a broad, resilient, and inclusive financial services industry supported by enabling regulatory environment, I am sure that we will be able to achieve economic prosperity for our country. With that, I would like to extend my heartfelt gratitude to CFA Society Pakistan for successfully organizing its prestigious award ceremony every year. I would also like to congratulate all the winners and nominees. Let us continue to strive for excellence and contribute to the betterment of our economy and people by building a more inclusive, dynamic, and future-ready financial ecosystem. Thank you so much for your attention.
Ladies and gentlemen, that was the Honorable Governor of the State Bank of Pakistan. We are very privileged to have him as our chief guest. And now, if I may take this moment to draw your attention to these blue tents on your tables. This is a survey, which is quite a tradition here at the CFA Society events. Ladies and gentlemen, we don't just predict the future. We make, in fact, very confident PowerPoint slides about it. So let's dive into the same confidence. What you see is a QR code on that blue little tent. If you can either scan that, or you can also go to slide.do, and that is going to take you to our board tonight. And this is going to be the questions that we all love to ask, but we hate to answer. So let's take a look at them. They're also going to go up there. The way that you can reach this place is there. We would love your input, and let's see how right or wrong or how our forecast is going to play out in the days to come. So ladies and gentlemen, our first poll question is, what will be the average GDP growth over the next 2 fiscal years? This is fiscal year 2026 and fiscal year 2027. Choose one. Your 3 options are less than 4%, between 4 to 5%, or more than 5%. A lot of money is riding on your forecast, ladies and gentlemen. We'd love for you to pick on that. And interestingly, less than 4%, a very realistic, a very practical approach.